Chinese biggest EV makers warn staff that a sea of blood is coming. As the electric vehicle industry in China has surged forward in recent years at lightning speed, it's been an exhilarating ride of innovation and expansion. But as the saying goes, all good things must come to an end. And now it's time for a new phase. Consolidation. This means that instead of countless EV companies vying for the spotlight, we're likely to see a significant thinning of the herd. In other words, not all of them are going to make it through to the next stage unscathed. Why the sudden shift? Well, it's simple. The once rapid pace of technological advancement in the EV sector has begun to plateau. The wild frontier days of endless possibilities are giving way to a more sober reality. And unfortunately, for many of these companies, the future doesn't look rosy. You might have heard whispers of a looming sea of blood, a foreboding metaphor for the tough times ahead, and it's not just talk. There are concrete signs and indicators behind the grim predictions, which will be broken down in this video. Subsidy cuts. One significant indicator of the impending collapse of the Chinese electric vehicle industry is the reduction in government subsidies. Over the years, China has been a driving force in promoting EV adoption through generous subsidies, providing a crucial lifeline for many manufacturers. However, recent cuts to these subsidies have sent shockwaves through the industry, impacting the financial stability of numerous companies. For many EV manufacturers, especially those that heavily relied on government incentives, the reduction in subsidies has dealt a severe blow to their bottom line. These companies had structured their business models around the assumption of continued government support, making them particularly vulnerable to changes in policy. With subsidies dwindling, they now find themselves grappling with shrinking profit margins and increased financial strain. The implications of reduced subsidies extend beyond just the financial claim. They also signal a shift in government priorities and a recalibration of the country's EV strategy. As China moves towards a more sustainable and market-driven approach to EV development, companies that fail to adapt risk being left behind. One critical factor for contributing to the challenges facing China's domestic electric vehicle brands is the mounting pressure on gross margins. In the first quarter of 2022, these brands saw a significant 19% dip in gross margin compared to the previous quarter. The decline highlights the growing financial strain on companies operating in the Chinese EV market. Several factors have contributed to this decline in gross margin. Trade conflicts, particularly between China and other major economies, have created uncertainty and volatility in the market. These conflicts can lead to increased costs for raw materials, components, and other inputs, putting pressure on margins. Additionally, downstream battery makers, who play a crucial role in the EV supply chain, are facing higher costs. This could be due to various factors such as increased demand for batteries, supply chain disruptions, or regulatory changes. Whatever the cause, higher battery costs ultimately trickle down to EV manufacturers, further squeezing their margins. The combination of these factors poses a significant challenge for China's domestic EV brands. As they strive to remain competitive in a rapidly evolving market, they must find ways to mitigate the impact of declining gross margins. This may involve streamlining operations, optimizing supply chains, or exploring alternative revenue streams. The recent move by BYD, one of the leading players in China's electric vehicle or EV market, to buy back its own stocks is sending ripples through the industry. Typically, when a company resorts to buying back its own shares, it's seen as a signal that all is not well. In BYD's case, it's a clear indication that even the giants of the Chinese EV world are feeling the heat. BYD's chairman and chief executive, Wang Chengfu, floated the idea of purchasing back shares in an effort to boost the company's stock price. It's a move that's unusual and a bit desperate, a sign that the company is grappling with challenges that are larger than life, and it's not hard to see why. The relentless price war in the EV market has taken its toll, dragging down even stalwarts like BYD. Despite being one of the few Chinese EV companies that have turned a profit and hold the title of the world's largest EV maker alongside Tesla, BYD's stock price has taken a beating. In just the first 2 months of this year, it plummeted nearly 8%, following a dismal 23% drop throughout 2023. These numbers speak volumes about the magnitude of the challenges facing the industry. Sure, buying back shares might seem like a savvy move to shore up investor confidence and protect shareholder interests, but when you take a step back and take a broader view, it's hard not to feel a sense of unease. Moves like this only serve to raise questions about the long-term viability of the Chinese EV market, and by extension, the broader economy. In the end, BYD's decision to buy back its own shares is just one of the numerous pieces of evidence that trouble is brewing in the Chinese EV industry. And while the giants of the industry may be able to weather the storm for now, the road ahead is anything but smooth. As the saying goes, desperate times call for desperate measures. And in the high-stakes world of Chinese EVs, it seems that is truer than ever. The wave of bankruptcies sweeping through the Chinese electric vehicle industry is perhaps another of the most alarming signs of trouble on the horizon. Even giants like BYD are feeling the pressure, so you can only imagine the uphill battle smaller companies must face. In just the past few months, 5 Chinese EV makers have thrown in the towel, a stark reminder of the unforgiving nature of the market. Take WM Motor, for example. With $5.3 billion in capital and some seriously impressive technology under its belt, it seemed poised for success, but even that wasn't enough to cut it in the ruthless world of Chinese EVs. Now, the company is scrambling to find new investors, but the outlook is grim. Then there's Evergrande New Energy Auto, a startup backed by one of China's largest conglomerates. With seemingly endless resources at its disposal, you'd think success would be a given, but despite massive investments, the company found itself hemorrhaging cash, setting a negative record of losing $17 million on every EV sold. It's a cautionary tale of what happens when ambition outpaces reality. And it's not just these high-profile cases. Companies like Nuitron and Letton have also fallen victim to the brutal economics of the EV market. Even Lane, once considered ahead of Tesla by a decade, couldn't escape the tide of bankruptcies sweeping throughout the industry. What's perhaps most concerning is that this is just the beginning. Experts predict that between 20 and 30 more Chinese EV companies could meet the same fate this year alone. The sight of EV graveyards scattered throughout China's urban landscape serves as another reminder of the rise and fall of the Chinese electric vehicle industry. 2 decades ago, spurred by government initiatives to compete with Western car makers, the EV sector experienced a boom unlike any other. Generous incentives and government support made it easy for startups to thrive, focusing on innovation rather than profitability. However, as the industry burgeoned and the number of EV companies soared to over 500, Chinese officials recognized the need to tighten regulations and set higher standards for incentives. Some requirements, such as sales quotas, prompted EV companies to strike deals with car-sharing companies to artificially inflate their numbers and claim incentives. Yet these deals often led to a surplus of unused EVs. Hence the proliferation of EV graveyards, vast expanses where abandoned EVs lie dormant, a testament to government overspending and industry mismanagement. The struggle isn't limited to smaller players. Even major automakers like BYD and NIO are feeling the pinch. BYD, despite turning a profit on EVs, is grappling with financial woes. Meanwhile, NIO, once hailed as a promising contender in the EV market, finds itself hemorrhaging money, with losses amounting to $355,000 per vehicle last year alone. Desperate for fresh capital injections, NIO's management has embarked on a global quest for funding, underscoring the severity of the industry's challenges. These woes are compounded by an ongoing price war and other market pressures, with predictions of at least 20 more bankruptcies looming on the horizon. The struggle is real, and it's affecting not only small startups but also major players. One of the pivotal reasons behind the struggles of Chinese electric vehicle companies lies in the limitations of the domestic market itself. While China boasts the second largest population globally, even such a vast market has its boundaries. With an abundance of EV manufacturers competing for a slice of the pie, it's becoming increasingly evident that not all can thrive in this crowded space. Most of these EV companies primarily focus on the domestic market and don't export their products. Consequently, their success hinges solely on their performance within China. However, with fierce competition and the ongoing price war, many find it challenging to gain traction and secure significant market share. Even those that manage to eke out a profit often operate on razor-thin margins, leaving little room for error. The survival of some major players in the Chinese EV industry can be attributed to their success in the international markets. Companies like Geely and MG may not be household names in China, but they've carved out a niche for themselves abroad. By positioning themselves as affordable alternatives to Western legacy brands and leveraging low production costs, they've managed to stay competitive. The most glaring indication of trouble in the Chinese EV industry is perhaps the staggering number of casualties it's left in its wake. Back in 2019, the landscape was bustling with over 500 EV startups, each vying for a piece of the action. But fast forward to today, and the picture looks starkly different. Out of those 500 manufacturers, around 90% have met their demise, a staggering statistic that underscores the ruthless nature of the market. Even among the remaining 10%, many are teetering on the edge of oblivion, producing fewer than 500 vehicles quarterly. It's a grim reality that paints a bleak picture for the industry's future. Already, 80% of the Chinese EV market is dominated by just 10 companies, a trend that shows no signs of slowing down. As the industry continues to consolidate, we can expect to see more mergers, acquisitions, and bankruptcies in the years to come. Ultimately, what was once a bustling ecosystem of innovation and promise will be reduced to just a handful of major players, while the rest fade into obscurity. It's a sobering reminder of the absurdity of the massive electrification push that swept through China. While it's brought about significant advancements in technology and infrastructure, it's also left behind a trail of casualties, a cautionary tale of the perils of unchecked growth and competition. If you enjoyed this video, please subscribe to the channel and watch the next video.